All right, hello, welcome to this another podcast. This is SeeWing Yee from the Yee Real Estate Network, and once again, I have a special guest speaker, my friend and business partner Richard Advani from Supreme Lending, and he does investment loans in all 50 states for real estate investors for many years. He also does owner occupied homes lending in everywhere also, not just California, which he's home based. So today's topic is what is number one rule that investors they're missing, they lost focus in. So we can talk that one thing, okay? But before we do that, I'm going to share a screen. I'm going to start every session for my future podcast with this very important foundational things that every investor should think about. First and foremost, I'll do it, these two slides, I'll do it very quickly because I want to get to the meat of the content that we can discuss between Richard Advani and myself. So real estate income property is what I call is the ideal investment. It is history's most proven multi-dimensional real estate asset class, especially single family home investing. So quickly, let me go through what is the ideal, IDEAL investment stands for. I stands for income, D stands for depreciation, E stands for equity growth, A stands for appreciation, and L stands for leverage. Income means the positive cash flow that you're getting monthly and annually. Is the passive income. You are buying an investment property where your tenant is going to pay down your mortgage. This is amazing. Your renter is going to make you rich. Simple, right? So the income, the passive income, and then in the future, long term, your income, the rental income, going to grow, and then your debt obligations may decrease. Then at some point in time in your financial future, you're going to have passive income to offset your earned income so you can achieve financial freedom. Next, the D stands for depreciation. Depreciation is a paper write-off. Every investment property you purchase have a huge tax benefit that many other investment asset class does not afford you. Depreciation, I'm not a tax advisor, but it allows you to write off your investment property on an annual basis through paper depreciation write-off, and allow you to significantly reduce your income subject to taxation. Okay, and number three, and E and A, equity growth and appreciation is kind of the same thing, right? I mean, on historical basis, investment income property appreciate over time, typically 3 to 5% in a long-term growth based on history. But many of you know that this past 18 months, we have seen record-breaking appreciation everywhere in the US. And finally, leverage. No other investment asset class, stock market, mutual funds, anything out there that you afford you to leverage. Leverage means you don't have to put 100% of your money to purchase an asset. With real estate, all you need is 20 to 25%, sometimes even less than 20%, sometimes even 15%. Right? You're only risking 15, 20, or 25% of your money minimum. Then a lender, a mortgage company in which Advani does, will leverage the rest of your purchase. Therefore, by leveraging your real estate investment property, your rate of return is higher. So anyway, and then finally, here's my real estate investment philosophy that I've been practicing for the 15 years. Since 2004, I've been doing this real estate investing business. You buy real estate and wait, not wait to buy real estate. Number two, you are not going to get rich on real estate you do not own. And finally, you can make money with real estate or you can make excuses, but you cannot do both. All right, with this foundation piece out of the way, let's get back to sharing our screen. Richard, Advani, and myself. So here's what we can talk about. I know in the past 18 months, and even before that, there's so much chatter, there's so much information through YouTube channel, through various podcasts, through whatever means with the social media, with the internet, right? I really in real estate, there's so much information out there, which is good. The more education you achieve, hopefully the likely you can make an informed decision to purchase real estate and income property with that in mind. But what I found recently, and I look at YouTube channels quite a bit. Let's see what other people are doing. But my takeaway of watching all these YouTube entertainers about on real estate is that there's so much fear. There's so much people talking about the doom and gloom. A lot of scary topics. People like, I mean, it can really paralyze somebody with fear because all this negativity, there's a crash, there's a correction, or too much appreciation, or all this kind of chatter. So if you want to become a serious real estate investor, okay, that's one thing you need to focus on, try and true, right? And don't worry about all this negative news you've been hearing. It's just we have to focus on cash flow, right? Cash flow. You need to find investment property where the rent, with your monthly rent that you're collecting on your income property, will exceed the total of your debt obligations, your monthly mortgage payment on the loan, and your property taxes monthly, your insurance monthly, and your property management fee, which is 8 to 10% of your rent, and then typically factor in 5 to 7% for annual vacancy and maintenance factor into the equation. So, so another thing we need to focus on is the 1% rule. Now, if you buy investment property, typically for $100,000 or less, you need to apply the 1% rule, and that will give you a return which will become positive, whether you buy all cash or whether you're going to leverage through an investment loan. 1% multiplied by 100,000 is $1,000 monthly gross rent before deduction. This formula will give you very good positive return and positive cash flow. However, when you buy investment property that are higher than 100,000, the 1% rule may not apply anymore. But I'm gonna give you another formula, right? Anything over $100,000 investment property, up to 200, up to even 300,000, the formula you should apply is like 0.07% of 1% of the gross rent. Let me give an example, right? So I know there are many markets all over the country is growing so fast. In all 50 states. If you look at any kind of podcast, any kind of news about a local market, doesn't matter whether it's a Butte, Montana or Portland, Maine. The local realtor gonna tell you, oh, we have never seen a market like this. Record, low inventory, huge demand, lack of supply. The houses are appreciating at double digit, triple digit. Every local market can tell you that, whether it's California or Boise, Idaho, or Austin, Texas, or Orlando, Florida, it does not matter. So does that mean that you should, as an investor, you should buy in all these markets that shows record appreciation or whatever? No. Think about California, obviously. Richard and I live in California, but the number does not make sense. How could you buy a $1 million home as an investment property and then apply the 1% rule? You have to collect $10,000 monthly rent in order to cash flow. So forget about California. So, okay, Boise, Idaho is growing tremendously, right? 30% appreciation in the past 12 months or whatever, crazy. But you look at the median price of Boise, Idaho right now, $450,000. You apply the 0.07% rule, or you're gonna get a $3,000 monthly rent and do a 25% down loan to achieve a positive cash flow in Boise, Idaho? No. Okay, so in New York City or Chicago or Phoenix or Boise and Salt Lake City or whatever, it doesn't matter. So you have to find the right market that's growing very fast, extremely fast, that have a price that will meet your rent to value ratio. So as an investor, so let's, for example, let's use the market that my investment club is promoting, or in Austin, Texas, San Antonio, Texas, Las Vegas, Nevada, and then Cape Coral, Florida, and then Alabama and Central Florida, Orlando Metro. So I'm not gonna go over all the market, but let me give one example. Okay, even like in Raleigh, North Carolina, actually. So let's talk about Las Vegas, right? I mean, you're thinking, oh, a single family home, the lowest price point is around 300 or 320,000. You're thinking, wow, you cannot cash flow in the Las Vegas market anymore. False. You know why it's false? My research indicate Las Vegas is a good market because if you buy a 320,000 single family home right now, the people are renting for $2,200. So that means the rent have caught up with that market. You can achieve cash flow now. So you're asking yourself, why would somebody will pay you rent for $2,300 in Las Vegas to rent your 320,000 property? Because people making 80 grand, 100 grand, they, number one, they can't, there's no inventory for them to buy. So, or they can't qualify for a down payment. So they need to rent for a while or something like that. So what I've been hearing in the Las Vegas market, for every house that closed escrow on this type of $350,000 single family home for as a rental, there are 20 to 30 rental applications for that one house. Same thing in Austin, Texas. We have been hearing Austin is growing in some neighborhood in Austin in the past 18 months. Some property have grew 30 to 50 to 80% in a mere 18 months. Does that mean that as an investor, you should not buy there? No, you could dig deeper. So let's say you found a investment property, single family home outside Austin, could be, Kyle, could be Cedar Park, could be Round Rock, anything within 50-mile radius. I know inside Metro Austin, the median price is already $550,000. Isn't that amazing? Austin going to catch up with California in about 5 years in terms of home prices. It's just shocking. It surprised even me. So if you buy a $350,000 single family home outside Metro, believe it or not, you can find somebody who's willing to rent your house for $2,300. Once again, there are many high income earners in Austin living there right now, and many people moving into Austin, high-tech people, high-tech employees, right? Engineers, they are making 100 grand, 150,000. They cannot buy a home. They have to rent for at least a year, 2 or 3 years. And they have $2,300 to pay your rent on that property. So you can cash flow at 25% down, believe it or not. Cash flow like $200, $300. So to me, you can do that. You can still buy in Austin. Oh, you should have bought 2 years ago or prior, right? But nevertheless, yes. And then my Austin realtor tells me that there are 20, 30, 40 rental applications. People that are making 100 grand or even more, they're more than happy to rent a house for $2,300. There's a bidding war for rentals. People doesn't talk about that. Yeah, people, we've been hearing bidding wars to buy a home all over the US. People doesn't tell you there's a lack of homes to rent. Many people in a particular area, in hot markets, so that's in Texas and Florida mainly, right? Where there's so many or more people that are unable to buy a house, they are renting for the time being. And that's why the rent has really dramatically increased in those markets where, as a real estate investor, you can buy a home for a new build or resale home in San Antonio, in Austin, in Cape Coral, Southwest Florida, also a very good market in which we work with, and Central Florida, and in Raleigh, North Carolina. You can buy a home for $200, now no longer 250, $280 to $300 to $350,000 single family homes in the best area, high growth area, and you can find 30 to 40 rental applications that are willing to pay you $2,000 or more to on those homes. You can achieve positive cash flow. So think long term, You don't think about, oh, is the market going to crash? Is there going to be a correction? I mean, knowing that the rental market is so strong in so many areas, you can cash flow on a single family home for 275, 300, 350, even 400,000 single family homes in some of these markets in the South and Southeast. The rent have caught up with the rising appreciation, at least for the time being. So that's what I'm saying. So knowing they can cash flow, if you have the money, of course, not many people can buy a $300,000 with 25% down. We're talking like 80 grand down payment, right? Not many investors can do that. But anyway, so focus on this one thing. People does not talk about it. You look at all the YouTube channel, you look at all the podcasts, people talk about home buyers, primary home buyers, looking into this market. Nobody except my organization and we produce this kind of content. So as an investor, focus on the cash flow, and don't fall prey to all that negativity and all that that's such a negative talk out there. It can paralyze you. So sorry for this long presentation. Richard Advani, of course, not only it's time for you to talk, Richard. So not only he's a great investment loan agent, but doing a lot of loans for investors all over the country, but he himself owns multiple properties. He have, doing, I don't know, he has so much perspective. So what are your thoughts? I mean, what are your thoughts about what I just said?
Well, you had about 15 minutes there, so it's hard to recap all of it, but I definitely say the main thing to note is and I really liked what you said, that, you invest in real estate and not wait to invest in real estate. I've never heard that before, but I really like that. And that really is the truth, as we were talking about before we actually started recording the webinar, and SeeWing and I started getting pretty deep into it. So we're like, wait, let's start the webinar and then talk about it. But, we get asked very often, and we get asked every year for the last 10 years, is now still a good time? Is now still a good time? We know everything's gone up. And it's the same type of issues that investors deal with when you're investing in anything, right? Whether it's stocks or securities or crypto or whatever it means, whatever it may be, you always ask yourself, well, is it a good time? And some of the most wealthy investors in the world, Warren Buffett, Ray Dalio, basically say if you try to time the market, it's impossible. And they're the best at timing the market. And the best way to invest is to invest. And, if you're sitting on the sidelines, like a lot of people have, even, if we talk about 3 years ago, the market had been on a 6-7 year just upward climb steadily. And I had tons of, investors, family, friends saying, hey, what are you doing? Are you still buying real estate? Everything's gone up so much already. And most of those people, a lot of those people made the decision to wait it out for when prices come down. And here we are 3 years later, and a lot of those markets like Austin and Florida, in the last 3 years, those properties have gone up 40%, 50% in some of them. And those sound like big numbers, especially since California started to plateau. But, I can tell you from experience, I own properties in those markets, and they have gone up dramatically. So, let's say you have enough funds to buy 3 or 4 or 5 properties, or you have enough funds to basically, invest in stocks, right? And you got 100 grand to invest in stocks, and the market's peaked out. Well, not investing isn't the right strategy, because for all we know, stocks and real estate are going to keep pushing up the next couple of years. But the way to do it is maybe kind of split up your investments, right? So instead of going 100 grand all into stocks in one day, maybe do 10 grand a week over 10 weeks. And that way you're hitting the various points of cost. And the same thing with real estate. I mean, I've got 19 properties at the moment, and I'm still buying even in this market where it is super high. And people ask me, well, what happens if the prices drop a little? Well, being in the business, I know the fundamentals are there now in terms of lending and home ownership, which weren't there. And that is what led to the last collapse. People buying properties and being able to buy properties that shouldn't have been able to. But also, if you're buying real estate with the right fundamentals and the right markets that make sense numbers wise. And hey, look, these days the inner markets like Austin and parts of Florida, you may not be making a positive cash flow. You may be being break even, but let's say property values do go down in 2 or 3 years. Well, my answer is simple. I'm going to buy more real estate to bring my dollar cost average down. And let's say I bought a piece of real estate in a market that was a little higher, and that market went down 3 years from now. Well, I'm especially going to buy more real estate in that market. So in essence, to kind of recap what I said and what SeeWing was saying as well is, you can't invest from the sidelines. You've got to get off your couch and you got to get out of your savings account. Because how much are you guys making in your savings account? 0.6% if you're lucky, if you've got 200 grand there. And what is inflation? 1.6 to 2%, although I think it's closer to 5%, but everyone's kind of digesting that. But that means you're losing money, having money in a savings account. And it's amazing how much of this country and how many people have money in savings and think that's the path towards retirement and wealth. And it's not. You're going to lose money that way. Great hedge against inflation is tangible things, real estate, for example. And then you pair that with the 30-year fixed mortgage. It really is a recipe for wealth and for building generational wealth. And as SeeWing mentioned, you're able to mitigate taxes too, because for the first 27 years you own the property, you can depreciate it and offset the income you're making, which, depending on your tax bracket, that's a 30 to 50% jump right away. If you're making $400 a month in cash flow, well, you're offsetting that with depreciation. It's really like $600 a month once you factor what's hitting your pocket. So I'm still, obviously, I'll go on real estate, and I'm continuing to invest myself, even though everything has gone up, and it's probably going to continue going up, and the demand is crazy right now. And the last thing I'll say is most of what us as real estate investors as a whole have invested in the last 5 years, 6 years, are properties that were kind of in the suburbs of the main cities, because that's what made sense cash flow wise. And what we've seen in the last year is, as opposed to initially all of us were afraid of having tons of vacancies and stuff, we didn't see that. In fact, what we've seen is the opposite. Tenants are staying longer, and a lot more people are moving out to the suburbs. COVID has changed how people kind of view living in space. And, a lot of people have migrated out of the cities. And coincidentally, we all own properties in the suburbs because that's what made sense cash flow wise. So everyone who has bought real estate, even as soon as last year, has done very well. I have clients who bought properties with SeeWing in Austin a year and a half ago, and for 200 grand outside of Austin, in Temple and places like that. And those same properties are worth 260 grand today, 2 years later. They've gone up 30%. So get off the sidelines, make some smart real estate investments, do your diligence. But sitting on the sidelines and hoping for the market to drop and then buy it super low and get rich quick, that's not how it works. You need to build wealth steadily, consistently over time.
Yep, well said, Richard. Thank you so much. And with that said, we're going to conclude this podcast, and we have another one in about 5 minutes. Richard, stand by. I will send you a new link. Okay.
Sounds great.
Thank you so much, everyone. Thank you for attending. This is SeeWing Yee from the Yee Real Estate Network, and Richard Advani from Supreme Lending, a nationwide investment loan advisor. Thank you so much. Have a nice day. Bye-bye.